It's not going to feel very good. It's slow growth, and it's slow because the economy needs to adjust to this new reality, this new trading relationship, this new trade friction with the United States.
Canada's central bank lowered rates this week to the surprise of no one. Tens of thousands of jobs have been lost over the summer. And of course, inflation, if not easing, does appear at least contained, which opened the door for that rate cut. But as the bank said in its statement, the path ahead will still be very much determined by what happens on trade. Tiff Macklem, Governor of the Bank of Canada, joins us now. Thanks for being with us.
A pleasure, Amanda.
Just reflecting on the complexity of this decision, more than most, I would say, and even more than most in your tenure, how complex was this?
Well, look, uncertainty is still elevated. And, as you understand very well, monetary policy can't undo the effects of tariffs. We can't reverse that. The only thing we can do is try to help the economy adjust to a new trade relationship with our biggest trading partner and make sure we keep inflation well controlled. Canadians are still, they remain concerned about the cost of living. And, our job is to worry about that for them so they don't need to worry about the cost of living. And certainly that's what we're focused on. Coming to the complexity, because it's a very sectoral shock, it's very complicated. The tariffs have been, they've been on again, off again. It's been a little more stable lately. That does mean you've really got to look at this from a risk perspective. And the decision to cut today really reflected the fact that the risks had shifted. The economy is weaker, as you mentioned. While there's some mixed signals, inflation does look a little more contained. And against that background, a cut was appropriate.
You mentioned, of course, and again, this uncertainty of what happens with tariffs, not in your hands. It's still very much an unclear picture of where this goes. So you do have these scenarios of an escalation of the problem and a de-escalation of the problem. So just let's talk about, we don't know likelihood of those two things, but sitting here today and you're looking at the Canadian economy, the question a lot of people want to know is, are we sliding towards recession? We got that contraction in the second quarter. There's a concern about it. What's your feeling about which direction we do go?
Well, as you said, it's going to depend a lot on what happens with tariffs. The simple arithmetic of it is that 25% of our GDP is exports to the United States. We are very integrated with the United States. What happens with U.S. tariffs has a very big impact on our economy. If tariffs stay roughly where they are, that would be the current tariff scenario that we put out in July. We were expecting a sharp contraction in the second quarter. In fact, it came out at negative 1.6. We were monitoring negative 1.5. So it was very much as expected. And we saw a very sharp drop in our exports, down 27%. That partly reflected the fact that businesses in the first quarter pulled a lot of those exports forward to get ahead of the tariffs. So that boosted first quarter GDP. Of course, that unwound sharply in the second quarter, and you saw this big drop. Going forward, if tariffs stay roughly where they are, we are projecting a recession. We're projecting slow growth, something around 1%. It's not going to feel very good. It's slow growth. And it's slow because the economy needs to adjust to this new reality, this new trading relationship, this new trade friction with the United States. Why is growth not negative? Well, we expect exports we don't expect a lot of growth in exports, but we don't expect a further big decline. We are seeing some consumption growth. We saw a little bit of recovery in housing. So we think that'll be enough to get some modest growth. But as I said, it's not going to feel very good. And then there are other scenarios. If there was a significant escalation of the tariffs, yes, you could see another negative quarter or two. So yes, that would be a recession. Hopefully, if we can de-escalate some of those tariffs, that recovery and growth will be better.
You made the point today that the tariffs right now, as we're experiencing them, they're big, but they're very targeted. There are a few industries that are really suffering, but most of our trade with the U.S. still governed under our trade agreement, still free trade, zero barrier. There is a worst case scenario, of course, where we renegotiate this deal and across the board, we lose that zero status and we go to some other number. Are you modeling internally at the bank? Are you saying, what does 5% look like? What does 7% look like? We don't know, of course, but do we have to be prepared for that?
We have done those scenarios and we've published them. The escalation scenario in the last monetary policy report was, I'd have to double check exactly, but I think it was 10% across the board. Back when this started, you remember the U.S. imposed 25% universal tariff on Canada. Fortunately, it lasted a day. I think the U.S. realized this was going to be profoundly damaging to their economy as well as ours. So yes, there are worse scenarios, and there's no question that they would have a very serious effect on the Canadian economy. We have done those scenarios. We've published those. I'm not really going to speculate on what's going to happen with CUSMA. I think the fact that outside of these specific sectors that the U.S. has targeted, CUSMA has been respected is a very good sign. It's a good thing for Canada. It's a good thing for the U.S. Today or yesterday, the U.S. signaled that it is launching the process to review, is launching some consultations as part of the process of that review. Canada's doing the same. Again, I think having a deliberate process, that's a good thing. But yes, there is uncertainty about where this lands. And until that gets resolved, yeah, it's tough for businesses to make business decisions. People are going to be worried about their job, particularly if they're in sectors that the U.S. is particularly targeting. Let's hope we can, CUSMA, Canada-U.S. NAFTA, Canada-U.S. Free Trade Agreement, they have served both countries very well. They have raised prosperity in both our countries. So, let's hope we can get back to something that makes more sense for both of us.
Meantime, you alluded to this as you watch prices. Businesses are adjusting right now. On the fly, we are trying to diversify, and there's cost in that. New suppliers, new supply chains, new markets, all of that brings kind of inflationary pressure that presumably businesses are going to have to pass on to consumers. Kind of a two-part question. Do you think we've seen that yet, or just the very beginning of it? And as somebody whose job is to keep our prices stable, if we really have to pivot to new markets, how concerned are you about the inflationary impact of all of that?
Well, as you indicated, when we talk to the businesses, particularly export businesses, but even many domestic businesses, they import, they import some of their inputs. And what we hear from businesses, they're looking for new suppliers. They're looking to diversify their exports. Our exports are 75% of Canada's exports go to the United States. The U.S. is always going to be just look at a map. U.S. is always going to be our biggest trading partner. But we've been talking about diversifying trade for a long time. We actually haven't succeeded. I think now it's a bit of a wake-up call. These new tariffs, the unpredictability of our relationship with the United States, I think, is underscored for businesses. Is yes, they need to look for new markets. It's been very easy to export to the United States. It's gotten a lot harder. Businesses are now putting more effort in figuring out how to get product to new markets, how to develop those markets. And as you said, that all has some costs. It's good, it's a good thing to do. It'll make us more resilient. It'll improve our growth going forward, but there are some costs. And, yes, our job, as I said, is to ensure that a tariff problem doesn't become an inflation problem. That is, that's job one for us. We do want to, as much as we can, support the economy through this adjustment. But, part of our role, the biggest part of our role, is just making sure that inflation remains low and stable, because that's going to create the best environment to do business in. That's going to be one less thing for households to worry about.
On that front, there was a case to be made. Not many economists were making it, but some were, that you could have held steady here. We've seen weakness, of course, but there are some measures of inflation that do still brush up against the top of your range. And to the point here, there's a lot of unknown potentially of inflationary pressure ahead. When you think about kind of the comfort zone that you want to sit in, especially the experience of the last few years when inflation really caught a lot of us off guard in 2022, where do you see rates kind of settling in? I mean, I know you can't give me a number, but is there a kind of a natural place for interest rates to land in this country?
In terms of interest rates, look, we're taking it one decision at a time. Everybody wants to know what as soon as you've taken one decision, first question is, okay, what's going to happen to the next one? We'll take the next decision with the benefit of another 7 weeks or so of data, of surveys of businesses, of Canadians. The guidance I would, whatever guidance I can give is, look, we're weighing that balance of risk. We know, as you highlighted, that there are some new costs, and those will ultimately probably mostly get passed through to consumers. On the other hand, a weaker economy that tends to reduce pressure on prices. Companies have to discount things. They've got to move inventory out. That tends to put downward pressure on prices. So we're looking at that balance. Today, as I said, when we looked at that balance, softer labor market, a weaker economy, a little less upward pressure on inflation, and the fact that the government has now rolled back most of the retaliatory tariffs, takes a little bit of risk out of inflation going forward. That all tilted the risks in favor of a cut. We'll be reassessing those risks as we get to October. If the risks shift again, we've demonstrated we're prepared to move, but we're going to see where we are in October.
Where does stagflation sit in your kind of spectrum of concern here?
Well, I don't know. I grew up in the 1970s. So, to me, stagflation is like double-digit unemployment, double-digit inflation. That's nothing like what we have today. I don't want to minimize the difficulties we have today, but I mean, inflation is, latest readings, 1.9%. Our measures of underlying inflation are about 2.5%. Okay, it's not right on our 2% target, but this is low inflation. Mm-hmm. And the unemployment rate, yes, it's gone up, and particularly in the trade-sensitive sectors, we've seen significant job losses. But it's 7.1%. It's not double digits. So stagflation is not a word I would use for this situation. We are in a situation where there's downward pressure on the economy and some upward pressures on inflation, but I would not call it stagflation.
Fair enough. One thing we are dealing with, you alluded to it, the Prime Minister called it a rupture, and that is this sea change in how we think about our economy. And that is, of course, governor, an economy that already had some issues before all of this began. Our productivity isn't where it should be, hasn't been for a long time. Our business investment has been lagging. A lot of those, of course, are things that would be best addressed by the government, by fiscal policy. You said today monetary policy is a blunt instrument. You do what you can, but they do work together. And I'm curious for your thoughts on Canada's potential success at making this pivot.
Amanda, we've been, I think all of Canada really has been concerned about our weak productivity growth for some time. And there are things that we can do in this country to lower the cost of doing business, to make our economy work more efficiently. We don't need, U.S. tariffs to do those things. But maybe there's something about, now that the cost of doing business with the United States has gone up, maybe we need to get more focused on reducing the cost of doing business in Canada and get more focused on reducing the cost of getting our goods to overseas markets. So, we've been talking about a number of these things for some time, and I am pleased to see both at the federal level and at the provincial level, we're having more concerted discussions and policy initiatives than we've seen in many years. And so, what are some of those things? Well, if it's more costly to do business with the United States, why not reduce the cost of doing business in Canada? And you're now seeing the federal government, the provincial governments, really start to come to grips with our own interprovincial trade barriers. Many small regulatory differences across Canada, across provinces, and the more we can take a comprehensive approach to this, the better the easier it's going to be for businesses to do business across the country in a seamless way. Provincially, we've got different labor accreditations for many professions: lawyers, accountants, electricians, nurses, doctors. If we could mutually recognize those, we could have one labor market in the whole country for all these professions. So those are some of the things we can do. The other part of it is, as I mentioned, you go back to, we learned painfully in 2008-9 around the global financial crisis just how dependent Canada's economy was on the U.S. U.S. banks failed; they went into a terrible recession. Our banks were okay; our financial system was okay, but we got sideswiped in a very big way by the U.S. recession. There was a lot of talk coming out of that of the need to diversify markets, to diversify our exports, but we actually haven't accomplished much. I think now, though, I think businesses are waking up to the fact that yes, we have a new reality with the United States, and we do need to develop those markets. Part of that is improving our east-west transportation and building port capacity so we can get the goods to those markets, and there are a number of projects under discussion that would help to do that. So, from our perspective of monetary policy, I mean, these are ultimately decisions for elected governments, provincial governments, federal government. From the perspective of monetary policy, I mean, why do we talk about these things? Well, the more that we can improve the efficiency of the economy, the more we can grow the economy's capacity, the faster the economy can grow without creating inflationary pressures. That would be good for Canadians.
We, of course, do have a budget coming. It will come shortly after your next decision on rates. So there's that. But the expectation is that it's going to be a fairly sizable fiscal spend. We've already seen pre-announcements in the tens and tens of billions of dollars. That does some of the job of stimulating, one imagines, and some of the investments you're talking about and making change. How do you factor in the unknown, but knowing that the government this is not going to be a straight up austerity budget. There will be targeted spending that should be stimulative as you, on the other side of the equation, try to make sure inflation doesn't take hold, try to make sure increasing government debt doesn't send interest rates up anyway.
Yes, as you mentioned, Minister of Finance announced yesterday that the budget will be tabled November 4th, and we will certainly be reading that carefully. Monetary policy, it is a very blunt instrument. And we really need to look at sort of the add up of everything and what the overall impact is on the economy. And we'll take those fiscal plans as given, and we'll factor those into our forecasts and provide our best assessment of what that means for the economy, and ultimately then what is the path for interest rates that'll keep inflation close to the 2% target. I guess I would stress a couple of things. Fiscal policy, unlike monetary policy, can target specific sectors. And as you outlined at the beginning, most sectors actually are still tariff-free, but there are a number of sectors subject to U.S. tariffs. There's also Chinese tariffs on canola, seafood, pork. The U.S. has now added punitive tariffs on copper. They've increased tariffs on softwood lumber. So there are a number of sectors that are being profoundly affected, but other sectors, as long as you're CUSMA compliant, you're still tariff-free. So what that means is the impacts are very specific. That's not something monetary policy can address, but fiscal policy does have the capacity to target specific sectors, and you have seen a number of measures targeted at those sectors. Some of those are sort of short run relief, but the other more enduring ones will be, can we pivot those sectors to supplying, for example, steel and aluminum that we need in this country? So we will certainly be looking carefully at those. And then there are some potentially big national projects to improve east-west transportation, to improve port capacity, to be able to reduce our reliance on the U.S. Of course, those things will take time to build. The spending will be paced out over, many years. So we will need to look at, what is the sort of aggregate, what is the pacing, what are the offsets in the budget, where are cuts that are offsetting some of those increases. And as I said, we'll do our best to factor that into our projections and move forward from there.
The question of affordability is still the one that most Canadians have front and center, even in the context of this massive fight we're having with our biggest trading partner and this change that's upon us, like it or not. Most people care that their day-to-day costs are still too high and that they can't afford a home, which is true for people that don't already have one. In terms of kind of anything that can ease that, obviously, people care deeply about what you're going to do next because they want to know about the path of mortgage rates a lot of the time. But on the affordability question, are we doing enough? Is there something else that could happen to make lives a little bit easier for Canadians?
Well, look, unfortunately, tariffs have made everything harder. Tariffs mean increased trade friction with the United States. It means the economy is going to work less efficiently. So what does that mean? Well, sadly, that means that, it means there's some added costs. It means that our incomes are lower. So, if that's the only thing that's happening, cost of living is not going to be getting any better. It's going to be getting tougher. So, as I said, monetary policy can't really undo the effects of tariffs. It can't reverse that. Structural reform could. And, what is that? It's the things we were just talking about. It's reducing interprovincial trade barriers to grow our internal market and reduce the cost of doing business in the country. It's getting rid of some of those regulatory differences. It's speeding up regulatory approvals and reducing regulatory uncertainty so that, businesses who have investment projects can get moving with those and increase the capacity of the economy. I mean, fundamentally, if we want to improve affordability, we need to have an economy that is where productivity is growing faster, where we are more competitive globally. What does that do? Well, that will grow our incomes. And if we grow our incomes, then things become more affordable.
One thing I wonder how you grapple with is the role that the housing market and sector plays in our economy. It's a huge component of our economy as a sector in all its related pieces. Is it too big? And I say that because, of course, it's what you would call a non-productive sector. The investments made there don't have the same kind of spin-off benefits of others. Have we let it become too large?
Well, I don't really think that's a question for the governor of the Bank of Canada. I mean, people want homes. People like their homes. People want a nice place to live. Who can blame them? I think the challenge is, as a country, we've had a hard time keeping up with supplying the housing that Canadians want. And so, that has made housing harder and harder to afford over time. This isn't a new problem. It's been growing for at least a decade. From a monetary policy perspective, we certainly look at housing. First of all, the housing sector, it's an important part of the economy. It's also a part of the economy that's quite interest sensitive. When we raise interest rates, that raises mortgage rates, and that makes the cost of servicing your mortgage to buy a house go up. I think one thing, though, that we've learned over the last 5 years is that, when we had ultra low interest rates, that, really you saw a big run up in house prices that eroded housing affordability. We raised interest rates sharply. Yes, housing prices came down a bit, but of course the cost of carrying your mortgage went up. So housing affordability didn't get any better. And I think what that's telling you is you're not going to solve a housing affordability problem with monetary policy. Fundamentally what you have to do is you've got to grow the supply of housing. You've got to reduce the cost of home construction. Part of that is productivity. If you look at the time to completion on your typical home, it has been going up and up over the years. We have not seen a lot of innovation in how to build a house. We do need to think about new ways to build. There's certainly some new operations using modular construction. I'm not saying that's the solution for every house, but we do need to look at, okay, how are we going to improve the regulatory timelines, improve the productivity of construction? How are we going to, free up space for those houses? That conversation is happening across the country. It is a complicated conversation, though, because there's a federal aspect, there's a provincial aspect, and then, of course, at the end of the day, there's an important municipal aspect. And we're going to need to get all three levels of government working together to crack this. And we've got at least a 10-year deficit. This isn't a problem that's going to get solved over time, but the sooner we get going, the more progress we can make.
I have to ask you, you became governor of the Bank of Canada in the midst of an historic pandemic. You, not long after, dealt with inflation we hadn't seen in 4 or 5 decades in this country. And now you're dealing with the biggest rupture in global trade in certainly a century and a half. How do you like us so far, Governor?
Well, there's nowhere I'd rather be. Look, it hasn't just been tough for the governor of the Bank of Canada. It's been tough for everybody. I do feel that it is a privilege to serve Canadians. I'm doing the very best I can. I'm using everything I've learned over many years. Sadly, these are not the first crises I've dealt with. And we haven't got everything right at the Bank of Canada since I've been governor, but where we have got behind, we've caught up. And we did prevent the pandemic from being an even worse calamity. We did get inflation back to, we've been back to roughly 2% inflation for roughly a year now. I realize that it has been a very difficult period for Canadians. They have seen bigger changes in their cost of living than certainly, I'd like to have seen. But I do feel that the monetary framework we have in Canada is working. It's been tested like never before, but we are providing stability for Canadians.
All right, I'm afraid that's all the time we got, but it's great to have you with us. Appreciate your time.
Thank you, Amanda.
We've been speaking with the Governor of the Bank of Canada, Tiff Macklem. Before you go, here are 3 things we think are worth watching this week. In another pre-budget peak, the feds announced the Build Canada Homes Agency. It's a $13 billion budget aiming to build thousands of affordable homes. Not, mind you, homes that are affordable to the middle class, but transitional and public housing. It does fill an important but small part of the overall housing shortage. And speaking of that budget, we did get the date. It's November 4th. Between the big ticket items we've already seen announced and the spending cuts promised, it should be one for the record books, walking the line between investments that are intended to rewire the economy and austerity on government spending. All we can say is get out your popcorn. And negotiations officially kicked off this week on the North American trade deal. Who else misses the name NAFTA? The U.S. ambassador mused this week that America was hoping for a much larger discussion than just trade. The PM keeps referring to a trade and security partnership, so it does sound like more than trade to begin with. Beyond that, the U.S. might find that elbows are still very much up. That's WONK for this week. Thanks for being with us.